Welcome to my new video. My name is Mauro Ferrari.
We'll start with probably the simplest continuation chart pattern, which is called rectangle. We have a bullish and a bearish variant. Let's begin with the bullish rectangle first. Remember that now we are talking about continuation patterns, so they signal that price will resume its current direction after the pattern is confirmed. A rectangle happens when price begins to oscillate sideways, and the resulting highs and lows form horizontal lines. That will make the pattern resemble the shape of a rectangle, and that's where the pattern name comes from. The logic behind the rectangle as a continuation pattern is that price has been trending for a while. Now there is some consolidation bound to happen since the market cannot keep rising or falling forever. If you are a beginner, you eventually notice that price is always oscillating between these two modes. It's either trending or going sideways. I'm obviously oversimplifying this, but for the purposes of this video, this is a valid perspective. The proper way to trade a bullish rectangle is to wait for price to break above the line that connects the highs and to retrace back to that line to test it as support. This is the optimal scenario, of course, but that doesn't always happen. Sometimes price breaks that line and just keeps going. This can be a problem because if you are an anxious trader, you will try to chase price once it breaks the pattern. That can end badly. The logical stop loss is below the lows 2 and 4 because as price breaks the upper line to the upside, it will usually confirm a demand zone around 2 and 4, so you can count on the help of those buyers to protect your stop loss order. Take profit should be at least 3 times as large as the stop. Remember that a continuation pattern implies that price is trending, so you might as well take advantage of that. It's important to remember that there can be more highs and lows contained inside the rectangle. Rather intuitively, we also have the bearish rectangle pattern, which happens when price is going down, and after the pattern is confirmed, price will probably continue going downwards. The logic behind the pattern and the way to trade it is exactly the same as the bullish rectangle, of course. The only thing that changes is the side you're looking to trade. When price breaks below the line connecting the lows of the rectangle and retraces back to this line to test it as resistance, that's the time to open a short trade with a stop above highs 2 and 4. By the time price breaks below the lower line, it will usually confirm a supply zone around highs 2 and 4, so you can count on those sellers to help you. One of the problems you will find with these simple chart patterns is that price will oftentimes retrace much deeper and closer to the supply or demand zones. So you'll find that these patterns are actually a very inaccurate way of trading. This is why learning supply and demand trading is a better idea than following these simplistic patterns. Not always, of course, but for the most part, they are not the best way of trading at all. However, some people find it easier to look for these patterns instead of analyzing price in a more organic way. The next pattern we are going to overview is called flag, and it's similar to the rectangle in a way, but it has a few extra twists. Starting with the bullish flag first, imagine that you take a bullish rectangle and rotate it in a way that both lines become downsloping. The pattern receives this name because it's supposed to resemble the shape of a flag, the trending part of price being the pole and the consolidation being the flag. Once again, a simple analogy, but might be useful for quickly recognizing the pattern in a visual way. The confirmation for the bullish flag happens when price breaks above the upper downsloping line, and then retraces back to it to test it as support. One advantage of the flag over the rectangle is that since we are dealing with a downsloping breakout line, price needs to retrace deeper in order to signal a trade. That means your entry will be closer to your stop, and therefore you will take less risk. The stop loss should be below the lowest low in the flag, and the take profit should be at least 3 times as big as the stop. The bearish flag is exactly the opposite, so imagine that you take a rectangle and rotate it in a way that both lines become upsloping. The confirmation for the bearish flag happens when price breaks below the lower upsloping line, and then retraces back to test it as resistance. One advantage of the flag over the rectangle is that since we are dealing with an upsloping breakout line, price needs to retrace deeper in order to signal a trade. That means your entry will be closer to your stop. Therefore, you will take less risk. The stop loss should be above the highest high in the flag. The take profit should be at least 3 times as big as the stop. The next pattern we are going to study is also very simple, It's exactly the same shape for the bullish and bearish variations. The pattern is called pennant, and it consists in two lines that converge to each other. We already saw reversal patterns that had lines converging to each other like in reversal wedges, but in those patterns, price was trending. In the pennant pattern, price is going sideways, so you can imagine a horizontal line that describes the angle of the pennants. Another characteristic of pennants, which differentiate them from other patterns like symmetrical triangles for example, is the fact that they are formed by small price movements in the middle of a powerful trend. Once again, the only difference between bullish and bearish pennants is the direction of price before and after the pattern. In a bullish pennant, price will be going up and a pennant will appear. Once price breaks the upper line and retraces back to the upper line to test it as support, a buy signal is generated with a stop below the lowest point of the pennant and a target at least 3 times as big as the stop. In a bearish pennant, price will be going down and a pennant will appear. Once price breaks the lower line and retraces back to the lower line to test it as resistance, a sell signal is generated with a stop above the highest point of the pennant and a target at least 3 times as big as the stop. Next, we have a slightly more detailed set of continuation patterns, which are the triangles. These patterns can be divided into symmetrical, ascending, and descending, and some of them only have bullish or only bearish variations. Let's begin with the symmetrical triangle. The symmetrical triangle is actually very similar to a pennant. The only real significant difference is that triangles tend to be larger and pennants tend to be quite small. Other than that, they are indeed very similar. In a symmetrical triangle, we have two lines converging to each other symmetrically. So the upper line is downsloping and the lower line is upsloping, and they have mirroring angles. This pattern has a bullish variation where price will be going up and then a symmetrical triangle appears to signal a continuation to the upside. The buy signal happens when price breaks out of the triangle to the upside and retraces back to the upper line to test it as support. The logical stop is below the lowest low in the triangle or below a confirmed demand zone, and the take profit is at least 3 times as large as the stop. In the bearish variation, price will be going down and then a symmetrical triangle appears to signal a continuation to the downside. The sell signal happens when price breaks out of the triangle to the downside and retraces back to the lower line to test it as resistance. The logical stop is above the highest high in the triangle or above a confirmed supply zone, and the take profit is at least 3 times as large as the stop. The next pattern is the ascending triangle, which only has a bullish variation. The difference between a symmetrical triangle and an ascending triangle is that in the latter, the highs form a horizontal line and the lows form an upsloping line. This signifies the imminence of a bullish market by the creation of higher lows. The buy signal happens when price breaks the upper line to the upside and retraces back to it to test it as support. The stop can be below the lowest low in the triangle as a standard or below a confirmed demand zone. The take profit target at least 3 times as big as the stop. The other pattern that finishes the continuation triangles is the descending triangle, which only has a bearish variation. In the descending triangle, the upper line is downsloping and the lower line is horizontal. The progressive creation of lower highs signifies the imminence of a bearish market, hence why the descending triangle is a bearish continuation pattern. The sell signal happens when price breaks the lower line to the downside and retraces back to it to test it as resistance. The stop can be above the highest high in the triangle as a standard or above a confirmed supply zone, and the take profit target at least 3 times as big as the stop. To finish off the continuation chart patterns, we have the cup and handle pattern, which has a bullish and a bearish variation. Let's begin with the bullish variation first. The cup and handle is formed by 2 convex arcs. One large arc followed by one small arc where the highs seem to be hitting a resistance wall. The 2 arcs in alignment make the price pattern resemble a cup and handle, hence the name of the pattern. The fact that the handle or the smaller arc retraces just a little bit and then hits that resistance wall again signifies bullish power. When the price breaks the resistance and retraces back to test it as support, we have a buy signal. The logical stop should be placed below the lowest low in the handle, and the target should be at least 3 times as large as the stop. The bearish variation of the cup and handle is actually called reverse cup and handle, and it looks like a cup upside down. In other words, we have a price formation composed by 2 concave arcs, one large and one small. The lows of these arcs seem to be hitting a strong support. When the price finally breaks the support to the downside and retraces back to test it as resistance, we have a sell signal. The stop should be above the highest high in the handle or the small arc, and the take profit target should be at least 3 times as large. This finishes the continuation patterns.
If you liked the video, please subscribe to my channel.